Welcome to the Compounders Podcast. On this show, we explore the topic of compounding from various angles, including through interviews with public and private company executives, investors who focus on compounders, and newer investment firms that are building a business they hope will become more valuable over time. All opinions expressed by your hosts and the podcast guests are solely their own opinions and do not reflect the opinion of SNN or its affiliates. This podcast is for informational purposes only. It is not investment advice and should not be relied upon for any investment decisions. We are not recommending the purchase or sale of any securities. The host and guests may be beneficial owners of the securities discussed. You should not assume that the securities discussed are or will be profitable. My guest on the show today is Todd Wenning, the president and CIO of KNA Capital. Many of our listeners might have come across Todd's excellent discussions of Moats during his time at Morningstar and Ensemble Capital, or on his Substack Flyover Stocks. Todd founded KNA Capital in early 2024, and I was eager to speak with Todd about what pushed him to start his own firm, why economic moats are so important to him in his process, how he decided on the right level of concentration, what he finds so valuable about the process of teaching undergrads, and why nostalgia can be a very attractive theme to invest behind. And without any further ado, here's my conversation with KNA Capital's founder, Todd Wenning.
Todd, you and I graduated from college the same year in the early 2000s, and you've had a long tenure in the investment industry since then. What made you feel ready to start your own firm in KNA Capital?
Yeah, it really was just a confluence of events. One, I got to the point where I was in my early 40s, and I thought, if I want an opportunity to help people and compound capital for 3 decades, now's the time to do it, right? And so I had an opportunity where I'd separated from my former firm. I had been doing some writing for a long time, and it just felt like I had developed my own personal investing philosophy. And I wanted to test it, and I wanted to see how I could do. I took a bet on myself, and just everything kind of came together at the right time for me. There's really not a great time ever to do something like this, but everything just kind of felt great. And I just came off a great experience with Ensemble Capital, where worked closely with some very smart investors and learned how to really build conviction and ideas in a concentrated portfolio, and just timing felt right.
I'm curious about the differences in your approach from the places you've been before. How, if just to distill that down, you said you've kind of started to feel comfortable with your own style and your own brand. What maybe, it's probably not a wholesale change, but what nuances have you added to the philosophy and process?
I think where I started to differ from my former employer was I was a little bit more value oriented. So I wasn't so focused on high growth names. Now, if you look at the portfolio in KNA, the multiples are pretty reasonably high, like slight premium to the market. But I invest in really quality companies that I think deserve those premiums, and we can talk about that. But I do focus on safety first. So really focusing on avoiding long-term drawdown. So I can handle a short-term drawdown, but I'm looking to avoid those long-term losers where permanent capital capital is permanently impaired. So that's what I'm trying to avoid. So I'm trying to have a little bit more of a value approach. I also span market caps and kind of expanded the net a little bit outside of the US to include developed markets in Europe and Japan.
Got it. And the other thing that always fascinates me is how someone chooses an investment firm name. You didn't name the firm Wenning Capital. Why is that, and what does KNA mean to you?
Yeah, a couple of years ago, I was speaking with a former mentor, or not a former mentor, a current mentor, former employer. And he had named his company his last name 40, 50 years ago. And he told me he regretted making it his last name because he wanted, as he passed on the company, felt like it was their company and it's no longer his. And so I had that in the back of my mind. And of course, I was looking at all the mountains and trees and
rocks and stones and creeks.
Right. And those were all taken, of course. And so I thought, what is personal, but could still be passed on to another leadership team 30 years down the road. And so I picked my wife and kids' initials. That's it, KNA. And that way, if, down there, so this is how long-term I'm thinking, right? So I'm thinking, what if I have to pass this company on to somebody one day? I want to make sure that it's a name that they feel confident in and believe in and don't feel like, oh, this is still Todd's company.
Yeah, I love that. I think it's hard sometimes. Those changes, those intergenerational transfers between, the old guys and the new guys is harder when there's someone else's last name on the door. And so as you're thinking about going out on your own and you were developing this, kind of slightly nuanced philosophy relative to where you'd been before, how were you thinking about the profile of an investor that you were hoping to attract to the firm?
Really, I'm looking for people who have maybe followed me for a long time, understand my philosophy, have a business owner mindset. So not chasing short-term returns, that understand that this is a long game and we're not out to outperform the market over a 2-year period, even less time even. So we measure ourselves internally on a 5-year basis, and when I say we, I mean me at the moment. So it's just it's the royal we, I guess. But I'm measuring myself on the longer term, so 5-year terms, and I don't expect every client to hold me to a 5-year benchmark. And what I suggest in my conversations with prospective clients is measure me on 3 at the very least. So give me time to perform before you make judgments. And if that's too long for people, that's a good indication that we're not a good match, because I'm focusing with a business owner's mindset and want to be a partner with great companies for a long period of time. And so if that's not something that people understand or don't want to be a part of, that's fine. I'm taking my time to build this company, to build this firm, and I'm not in a rush to wow anybody with returns.
And you mentioned, there's a lot of people who followed you throughout your career, working at Morningstar and Ensemble. You've had a chance to develop a deep appreciation for company Moats. I think people probably associate you with that kind of thinking. I'm curious about, for someone who, hears that term and thinks it's jargon, and maybe some of that, the specialness has been lost in that terminology. Why is it so important to your specific philosophy to be thinking about moats all the time?
Sure. And I totally understand how people get a little drained by hearing the phrase all the time. It's overused, I think, and overapplied. And so it's just become a buzzword. And so one of the reasons I just started writing this series for my blog, Flyover Stocks, on economic moats, was I really wanted to explain what I meant.
Yeah.
I'm talking about economic moats. And so, one thing I tell, the students I teach in college is that the financial manager's number one job at a company is to increase the market value of the business. And so the CFO, the treasurer, the CEO, they should all be thinking about, how do we increase the market value of the business? And the way to do that is to invest in projects that out-earn their cost of capital.
Sure.
Very simple. It goes back to Finance 101. And so moats enable companies to consistently out-earn their cost of capital, because in capitalism, in a perfect capitalistic society, as soon as someone was out-earning their cost of capital, competitors would come in and start eating away at that superior return on invested capital. And eventually it would all work out to everybody's earning the average cost of capital. And so when I think about moats, I think about sort of in the classic Buffett fashion of, what is it structurally about this business that gives them an unfair advantage, and that the unfair advantage can persist over 10 plus years. So sometimes companies get temporary advantages. They last a year or two, but I'm looking for companies that have a real durable advantage and can reliably, to the extent that's possible, out-earn their cost of capital for at least 10 years. So that's how I'm framing, thinking about which companies are attractive to me from a moat perspective.
And as we mentioned, you had a blank sheet of paper when creating KNA Capital. So I guess I'd love to hear a little bit about how all that framework manifests itself in an actual strategy when it comes to security selection and position sizing and stuff like that. Because you can, mode is only an economic mode, and the ability to earn a high return on invested capital is only one aspect of all businesses, right? If you're three pillars, kind of business, value, and people. So we'll get a little bit into your concentric circles of how you think about that. But I'm just curious about how this having an overarching philosophy that moats are really important. How does that translate into a specific strategy?
Yeah, so going back to what we were talking about earlier with the type of clients that I'm looking to have at KNA and how I invest, it's from a business owner's perspective. So thinking about what businesses do I want to partner with for 10 plus years? And to the extent I can feel confident in that company's ability to out earn their cost of capital over a 10-year period, that gives me a lot more confidence in investing in that firm versus a commodity company or a company with no clear competitive advantage or differentiation, because that's something that I was reinforced to me during COVID. So in March 2020, I remember working with the guys at Ensemble, and we were up till, they were in San Francisco, I was in Cincinnati. I was up till 1 or 2 o'clock in the morning, going through every single company in our portfolio and thinking, are these the companies that we want to go through this storm with? And that's how I continue to think about building a portfolio is this a group of companies with a group of managers who I would go through a storm with and have confidence that they will not only get through the storm, but get stronger. And that's something that moats enable management teams to do. So I always say that moats provide management teams with time.
Yeah.
That's essentially what moats enable managers to do. So if there's the barrier to entry, and let's say there's a new competitor, it's going to take them some time to get up to scale. Management has some time
Yep.
to organize their team and organize their strategy and put it into place. Moats provide great managers with time. And so as I'm thinking about the portfolio, thinking about who I want to ride through a storm with, I would want to ride through a storm with great companies with moats and great management teams who I know will pick up share and capitalize on struggles elsewhere in the industry in an economic down cycle. So that gives me some ability to sleep at night, right? And think longer term. Because if I'm always worried about what's the next quarter going to be, that is completely alien to the way that I invest. And so I just don't want to be tempted into those sort of investments in the first place.
Sure. And concentration is something we talk a lot about here on Compounders. How did you settle on 15 to 20 stocks as being right for you?
So the way I think about the KNA equity strategy is I think about it as a portfolio and not as a product. And so I didn't think about, okay, this is a large cap growth portfolio, or this is a small cap value portfolio. This is, to me, a collection of great businesses that I think can compound value over 10 plus years. And that's my criteria in developed markets, right? In the US, Europe, Japan. And so thinking about the number of stocks I want to own, I was conscious of how many stocks I could reasonably cover as an individual. And so 15 to 20 fell about right, because I used to be on the sell side and I covered about 25 companies there. And that was a lot to do. And that was even in the same industry where you had some leverage in terms of knowledge leverage between companies. So 15 to 20 felt like the right number. That was about the size of the portfolio that I had helped manage previously. And so just thinking about, the allocations, what's a good size portfolio or position size in a portfolio, I felt very comfortable with that allocation. And so right now we've got 19 companies in the KNA strategy, and I'm comfortable in that 15 to 20 range. If it gets too much more than that, feels like maybe we're investing in our smaller ideas, too many small ideas and not enough big ideas. So that's one aspect of it. And the other aspect is how much weight do I put into each company. And so I try to keep it somewhere, at 10% max thereabouts. If it gets more than that, that's a pretty serious opportunity. Right now, the largest position is about 7 to 8%. So it's fairly evenly distributed. There are a couple of smaller names in the portfolio that have about 2% positions. And those are what I call emerging moats. So companies that have not yet kind of hit that critical mass of having very predictable cash flows, or they are really high quality companies that I just don't think the valuations are compelling enough to put 8% of them in the portfolio.
You mentioned that this is not a strategy that fits in a bucket, large cap value or small cap growth. And with that, there's not a lot of market cap focus when it comes to the way you present this strategy. So talk to me a little bit about, maximum or minimum size companies, the portfolio. Do you have those constraints? And then I'd love to hear what would be a weighted average market cap that would make sense for you, given, because you have the ability to invest in smaller things as well. You're not kind of bucketed only in the top end of the market.
Right. That seems to be an advantage to be, early on, especially without, $1 billion of capital. That gets really hard to start to invest in small businesses at a reasonable size. And so right now it's a small AUM, and I'm able to make material investments in companies of all market sizes. And that's an advantage I don't want to avoid. So I only have many small caps. I have a few, but most of it, it's probably kind of is how mid cap is, kind of where everything kind of settles. And I think that's a great weighted average to be in, because you have professional managers in the mid cap space, still a lot of growth potential. And as we've seen, certainly in the large cap space, I mean, historically that's been harder to generate high growth, but there's been plenty of high growth in the large cap space over the past 10 years or so. And so I don't want to avoid any market cap just because, I have the flexibility to do that right now at KNA and looking to take advantage of that.
Sure. And I mentioned the concentric circles that you have in your presentation, one of those being management, the other one being moat, and the other one being price. I'm curious, what that chart, how that using that chart manifests itself in an actual portfolio, but also, how do you handle situations when only two of those are overlapping?
I think it was 2017. I was another employer, and not my former employer, but a previous one. And I was thinking about how can I had a lot of thoughts in my brain. It's kind of like all these different things. Okay, like what do I actually believe?
Yeah.
In my investing. And I just started sketching and came up with these concentric circles and figured out, okay, I believe in moats, I believe in great management teams, and I want to pay a good price for them. Yeah. And so that's how I got the concentric circle Venn diagram. And I think I posted it one night before bed. I think it was in like September 2017 or something. And woke up the next morning and there were like 600 likes and kind of went viral on Twitter overnight. And so that was interesting. Going viral is a weird thing. But it's been important to me because it's helped keep me grounded. It's okay, how does everything come back to one of these three things? And so when one of those aspects are missing, whether it's moat, management, or price, I have to do more work or I have to avoid the situation. So, there's times where, company's got a great moat, looking at like an attractive price, but management's just not there for one reason or another. Maybe it's capital allocation, maybe it's a new management team, maybe the culture inside the company is a little bit broken and they had to bring in somebody from the outside and it's not clear how that's going to work. Sometimes there's a great management team and attractive price and the moat's not obvious, right? There's something that's not clear to me how the company is able to out earn its cost of capital over the next 10 years. So I avoid it. And then as we've seen, a lot more recently, there can be a great moat, great management, and price isn't there. Sure. Stocks are getting at a valuation where board returns are not attractive. And so I can't invest. So those are the three kind of categories I try to avoid. I think for quality investors in particular, so thinking about companies with great balance sheets, great management teams, moat, everything, the biggest risk to performance is what I call a quality trap, where there's just this halo around the company. but it's slowly eroding. The moat's starting to erode, and those are just some of the worst performing cohorts that in market history. Because you get the earnings growth slows down and the multiple contracts at the same time, so it's like a double whammy going the wrong way. And so you want to avoid those situations at all costs. And so that's one thing I'm always sort of paranoid about, is trying to focus on identifying weaknesses in moats. And I think we'll probably talk about moat trends later, but thinking about as things start to erode, that's when you really have to be concerned as a quality investor.
And what you're talking about is moat trajectory, which is something that the guys at WCM at SoCal have evangelized that idea, and I like that thought a lot. Right, moats aren't static. Businesses aren't static. Just because a company has a strong moat now doesn't mean it will last forever. I think the hardest part when you're thinking about that specific topic is assessing the trajectory, right? Because I think there's probably situations where it's really obvious that it's expanding, and it's really obvious that it's not expanding. It's everything in between that's challenging to assess and ascertain. So I'd love to hear from your process, how do you think about assessing the direction of the moat trend?
It's a great question. Moat trend is really hard to nail down sometimes, especially as an outsider. Just not being plugged into the company every day. Even people who work at the company full time may not always fully recognize the day-to-day changes happening. But Buffett talked about this quite a bit in his early work. He didn't call it moat trend or moat trajectory, but he was talking about widening the moat and how little things that the company does every single day, taking care of its customers, treating them right, taking care of employees, all of those things go into whether the moat is widening or narrowing. And he gave an example of the Geico moat. I think it was 1981 shareholder letter. Don't hold me to that. I'm trying to remember which one it was. But he talked about Geico's moat and gave a specific data point, their expense ratio, their costs, and how you can monitor that to see whether or not the moat's widening or narrowing. Having a specific metric really helps in that. So figuring out what is the moat source. So the kind of broad 5 moat sources: network effect, intangible assets, switching costs, low cost production, and efficient scale. So if you can kind of figure out which bucket, those are like kind of Morningstar 5 big moat sources. And if you can figure out which one it is, and then try to figure out a metric that's relevant to that moat, you can get a quantitative read on perhaps where the moat is widening or narrowing. So for example, I personally own and have owned since 2010, I think, a company in the UK called Admiral Group. And Admiral Group is an insurer. It's kind of like the Geico Progressive of the UK. And they used to have a great chart showing their expense ratio versus peers and how it trended over time. And that gives you a pretty good indication of whether or not the low cost moat is getting stronger or weaker over time. And we own Costco in the portfolio. It's a very small position given the valuation. But one of the things I look for there is the executive membership penetration, because it tells you, if you are an executive member at Costco, the difference between executive membership cost and being a Gold Star basic member is about $65, I think. And so it works out to, you have to spend at least $3,600 thereabouts to justify the extra cost. And so that works out to about $270 a month. And that tells you that that's a pretty relevant product for their customers, right? If they're going $270 a month on average, that means it's part of your routine. And so as more people become executive members as a percentage of the whole, that just tells me that the membership and Costco's offering is becoming increasingly relevant. So that's one way to think about measuring a trend over time, is just finding a metric that, whether it's something that's well-known, industry-specific, like expense ratio, or more customized, like what's the percentage of Costco members who are executive members versus basic members?
And this is a podcast called Compounders, so we talk to a lot of people with very similar philosophies. Let's find a great business with a great management team and buy it at a wonderful price. But of course, markets are smarter than that in a lot of cases, and you call yourself a value investor, and and maybe that's kind of like your nuanced perspective on your former experiences. So, what in your experience causes these wonderful businesses to trade at great prices?
It seems, having followed these companies, this sort of class of companies over time, there's general market sentiment where they get thrown out with the bathwater. That happens every once in a while. Hasn't happened lately, it seems. There haven't been that many. Maybe since 2022 was the last time you had an opportunity to take a big swing at some high quality companies that were trading down on inflation concerns. But other times they're more company specific, and those are more challenging. Because you have to have conviction in the underlying business, in the management team, to get through the storm, right? So thinking about a company like ODFL, Old Dominion Freight Line, which we own, LTL was in a very difficult space the past couple quarters, and management just kept going back to here's what we're doing, we're winning business, we're continuing to execute on our strategy. And I have every confidence that they're going to get through this weakness. And in fact, it's been pretty good the past couple of weeks. But thinking about how companies fight through these challenges, like it was 2017, I think, where Costco, again, we own Costco, and they sold down pretty sharply when Whole Foods got acquired. And thinking like, hey, Amazon, which my family owns, they're going to disrupt Costco's business model, right? And so the stock sold off. I forget the percentage, but it was pretty strong on that news. Thinking, hey, Costco's model, the warehouse model, is just Amazon's going to figure this out. And I remember I went home to my wife that night and I said, do you think you're going to change your Costco shopping behavior now that Amazon bought Whole Foods? And she's like, no, it's a completely different shopping experience. And I think sometimes that happens where analysts think one thing, but on the ground, the customers are like, that's just not even close to being accurate.
Yeah.
And so I think that's helpful too, is really understanding what the company's value offer is to its customers, how it delights customers, and then try to understand when there's a challenge, if that value offer has changed at all. So sometimes things happen in the market, sometimes they're company specific. But you really have to understand the company and what it does, what its values are, what its culture is like, what its advantages are, in order to, I think, successfully navigate those challenges.
And we're going to jump into the strategy a little bit and talk about some of your themes. But something struck me as I was looking through your presentation, which is that simplicity of business model is something that's important to you. Why is that the case?
One of the things I care about is trying to figure out what is happening at the company, right? I'm trying to avoid situations where I don't know what I don't know. There's always going to be something, but I'm hoping that's relatively small. And so when I think about conviction, I want to be able to hypothetically go on CNBC and be able to debate a well-informed short seller on the company and not feel like they're going to surprise me with anything that's happening at the business. But a more complex business, that takes a lot more time to figure out, to understand all the little nuances. And so I have a pet theory. I've never tested it before, but companies that have annual reports and 10Ks less than 100 pages, my guess is they outperform. That's my guess, versus companies that have longer 10Ks. Just I think simpler business models work both internally from inside the company and also externally as investors. If you're looking at a company that should otherwise be a very simple business, but it has a 300-page annual report, there's something going on there that is just opaque. And it's sort of like jumping into a pool of muddy water. Like you just don't know you don't know, right? And so being able to monitor all those things, that you don't know, you can't do almost by definition, right? So, being able to understand what all the moving pieces are of the business, trying to value that simplicity, just being able to grasp, Costco, again, very simple business to understand. But if Costco had a financing wing and also really complicated type of stuff, right? And so trying to keep things as simple as possible seems to work for me, at least. And so that's one of the things I value.
You have a couple themes that you're invested in that I wanted to touch on. The first is nostalgia, which is not a theme you hear much about in the investment world. Would you discuss that theme and maybe highlight one of the companies in the portfolio that benefits from that trend?
There's a great line in the TV series Mad Men where Don Draper, the main character, is flipping through pictures of his family from a couple of years ago when the kids were young, and he's got a great line about nostalgia. It's delicate, but it's potent, and I think that is really, really true. And I think as the more uncertain the world becomes, it's one of those things people cling to more. So thinking about happier times, right? When things seemed certain, whether or not that's true, we always put rose-colored glasses on the past.
Sure.
But in our minds, it's comforting to think about, playing games, brands of games that with your friends and your family. I've talked before about how when I drink Coca-Cola out of a glass bottle, it immediately reminds me of being at my grandmother's house in the 1980s. And Buffett talked about that, how Coca-Cola wants to be everywhere where you're happy, right? At baseball games with your family, movies, all those things, because there is something psychological that happens. There's an emotional connection to the brand. So every time you get a dose of that brand, it brings back those memories, either consciously or subconsciously. And so one of the companies that we've invested in is Nintendo. And that's near and dear to my heart because I was a Super Nintendo fan when I was a kid, and playing games like Mario and Zelda. They've just they've stood the test of time. You think about all of the content, video game content especially, that's come up since then. And that's the other thing about content, just everywhere. There's new content everywhere you look. It's never been easier to create content, and yet these nostalgic brands have tremendous value. They've held up through a generation, and that's really important. I think for a brand to kind of move into the nostalgia phase, it has to win a generation. Once it wins a generation, that generation who it won can pass that love for the brand down to the next generation, and then the next generation, and so on and so forth. So it stays relevant for decades, if not generations. So thinking about the parallel would be local sports teams, right? It's a way to communicate across generations. Like I'm a Cincinnati Bengals fan. We've had a rough year, but I'm a Cincinnati Bengals fan, and I can, lament those concerns to, my dad and to my son, and so we kind of connect, through the Bengals. And there's not much that can do that, right? Everybody's got different generations have different priorities, but what holds it together is things that we hold in common. One of those things I think increasingly is video games like Super Mario, and certainly we saw that with the movie that came out last year. My kids play Nintendo, and I didn't really push it on them. I'm sure I maybe did here and there, but They've embraced it. My daughter was Princess Peach for Halloween this year. My son was Mario one year. They've been, the kids at their school have Mario parties. I mean, it's still very relevant,
Sure.
Despite all the differences between my generation and my kids' generation. They come back to Mario because it's fun, it's consistent. They know what they're going to get, and I just think there's a lot of value in nostalgic brands that get underestimated. And certainly there's a lot to the Nintendo story. Certainly management needs to execute on monetizing those brands, but the potential to unlock the value is certainly there. I think, I am 95% sure that when I am 75 years old, I'm going to be playing Mario in one form or another. And so, and that my children's children hopefully will play Nintendo as well. And be familiar with the characters. And that's not for nothing. You think about how hard it is to maintain brands over generations. And I think Nintendo is one of those special stories.
Thanks for sharing that. I mean, as someone about the same age as you, vivid memories of playing Nintendo and Super Nintendo as I was a kid. So I have that same nostalgia that you do there. Another thing that you talk about is networks. And when people think about networks, they often think about the big tech companies that have that benefit from network effects. But you highlight some very different types of companies within the theme of networks. I'd love to hear about your approach to investing in companies that have deep and wide networks.
Right. As you mentioned, most people think about digital network effects, the classic example being eBay or Facebook. And the idea being that as more nodes are added to the network, it increases the value of the overall network, sometimes exponentially. And I think that there's something similar that happens in the physical world, so that the same ideas can be applied to the physical world. So think about, again, Old Dominion Freight Lines, which we talked about. So they're a less than truckload shipping company. And the more physical nodes or service centers, what they call them, like warehouses, they own throughout the country, the more efficient the overall network becomes. So the more places they can deliver to, the more they can do it more cheaply and more efficiently. And so as they add new network nodes, the network overall becomes more valuable to their customers and therefore to the business. Similarly with Copart, which we also own in the portfolio, with the salvage yards, being able to be closer to where salvageable cars are popping up around the country is an advantage, because again, they can be transported to various places and be closer to wherever the customers are. So having those transportation advantages really matter there. So I just think as physical networks emerge, those can be extremely valuable because they're much harder from a capital standpoint and to get into, because think about how hard it is to create a digital network, to disrupt a digital network, right? I mean, Facebook disrupted MySpace, but there's very few of those things. It's really hard to do, but physical networks take a lot more time, I think, and the possibility of disrupting them is much, much lower. So thinking about, let's say I wanted to create my own Old Dominion Freight Line. I mean, it's not only going to take billions of dollars of capital, but it's also going to take me battling with local regulators, trying to find land, because not everybody wants to have trucks coming in and out of their neighborhood all the time. So sure, you've got to be further afield from the city center to even get a chance. And so that's another advantage that like the Coparts of the world have, is they have legacy real estate in areas that they could never set that up in now. And cities were kind of built around them, because when they bought the land, they were out in the burbs, but now those burbs have become kind of more part of the city. So it's just economically irreplaceable assets. And so I think there's a lot of different ways to develop conviction in companies that have those physical network effects.
I love the idea that you get to share this wisdom that you gained in terms of assessing qualitatively and quantitatively assessing companies with young people. Teaching's been a big part of your life throughout your career. I found out that you're now teaching 3 sections at the University of Dayton. Curious what you find so valuable about the teaching process.
Yeah, I really enjoy it. I work with great colleagues and great students, and it's a two-way street. It's not just me kind of pontificating and all these kids are taking notes and learning from me. I'm learning from them too. And what I love about teaching intro to finance is that I have non-finance majors in there. And they all have beginner's minds, right? So they're asking simple questions,
sure,
that you kind of forget about. And as you become more experienced, you don't really think about, okay, why does the present value of a company equal the future cash flows discounted back to the present, and then why does that work, and why does working capital get returned to you at the end of the project? And trying to be able to explain these things to students in an understandable way is not easy. So it requires me to kind of go back to first principles and think, okay, what is actually happening here? Walking students through the income statement, through the balance sheet, through the cash flow, trying to figure out how we get to cash flow, how do we value businesses, how do we value projects. And, for someone who doesn't come from a math background, I mean, I was a history major, right? I did not come through business school. So I learned all this stuff in my professional life. And so maybe that gave me some sort of advantage in being able to break things down simply because it wasn't something I came up with, through going through college. But I just really enjoyed speaking with the students and learning from them. And it's a great way to stay connected to the younger generation too, to be able to, see them. They're all ambitious and they're all excited to start their careers. And some of them are extremely bright and motivated. And so it's really fun to be around that energy and to stay in touch with the younger generations.
I know that writing is also something that's a big part of your process. You spend a lot of time and effort posting on your excellent Substack, Flyover Stocks. How does writing help you clarify your own thoughts on an investment?
I've been writing publicly since 2006, which seems like a really long time ago. Now, I was fortunate to work for the Motley Fool back in the mid 2000s, and that was sort of the Substack of the era, where they were giving the keys to the car to anybody who was motivated to write and was well and trying to learn. And so writing publicly has been a great way for me to accelerate my development. I just mentioned I was a history major. When I got my first job at Vanguard, I had no idea what a stock was when I got it. I got it because I think because I had a good GPA and I was able to present myself well on the phone, and they thought, hey, we can train this guy. But I'm really grateful for that because for that opportunity. But I was able to with writing kind of flesh out what I believed in, right, and try to understand things and start thinking about things like, okay, if I say this, who will push back? Right. And what would they say to push back? And so now I'm thinking about both sides, right? If I make this claim, I have to be able to substantiate it. So I've got to set up what the alternative view is. So that was helpful. One thing I did at Motley Fool too was I worked to support some of the various newsletters. So there was a small cap newsletter, an inside value or a value investing newsletter, dividend investing, international. Then you had a kind of a high growth one called Rule Breakers. And so I would write these articles kind of with the theme of the newsletter, and then kind of pitch the newsletter at the end. And so that helped me figure out, okay, which of these newsletters and which of these styles is relevant to me, or makes the most sense to me. And so I started kind of gravitating towards the smaller cap, the higher quality companies, and the dividend investing. And so I actually had a newsletter in the UK called Dividend Edge. That was a dividend focused portfolio of high quality companies. And so running that newsletter was excellent experience as well. But then I wrote for Morningstar, and then I had my blog and wrote for Ensemble Capital for a long time. And the process of it, I can't imagine not doing it. Really. I mean, pretty much every fortunate event in my career, for the most part, has come through my writing. Just making connections with people who have read my articles and reached out and said, hey, I think the same way, or hey, even I disagree with what you're saying. But we're thinking about it thoughtfully and having a cordial discussion. So all these things have been positive to me. And so I really can't imagine not writing. And from my own research process, when I profile a company every month, it may not get into the KNA portfolio. It's just me, hey, this is an interesting company. I want to learn more about it. And as I start writing, often I start pulling threads, and I was like, oh, I didn't realize that part of it. And then I start digging into that. And then, that just helps you build a 360-degree view of the company faster than I would have if I was just reading. It helps me, sort of like what happened with the diagram. It's like, it helps me organize my thoughts. Try to figure out all the different angles that it might happen. And again, that really accelerates the conviction building process, in my opinion.
And are you using the Flyover Stocks Substack and the companies you're profiling that are not in the portfolio? Are you building a watch list? Is that part of it? Is that these are companies that you want to stay close to, and maybe there's one pillar missing, and what you're doing is just establishing, a group of companies that you can come back to, right? When something changes, either the valuation changes or there's a management change, or you see some evidence that the moat may be better than you thought.
Right, and that has happened. I go into every monthly profile thinking, hey, I'm just learning here. This is an interesting company. Some jump off the page a lot faster to me and go, this is a real opportunity. A lot of these I wrote before starting KNA as well. So I had a bench of ideas before launching KNA this past late summer, early fall. And that was really helpful to me. There were a couple of names like Games Workshop, Halma, and Howden's Joinery in the UK that we currently own in the KNA strategy that I wrote about in Flyover Stocks that I wouldn't have done the work on had I not been doing Flyover Stocks. So I think that's been an added benefit of doing Flyover Stocks.
Yeah, sure. So we've talked a lot about your philosophy and process, but I never like to leave a conversation with a manager without discussing a mistake. Is there a mistake that you've made that has forever changed the way you invest?
Well, how much time do you have?
Pick one. I have plenty of two, but pick one that you think was maybe was so profound that you said, I'm not going to invest in this company again. I'm never going to invest in this type of situation or company again.
Yeah, so the one that jumps off the page to me is Peloton, and my family still owns a little bit, and that's really just to remind me of the mistake. Yeah. And so that we invested in Peloton. It wasn't at the peak, it was like maybe the first 30% drawdown from that high. But I was where I made a mistake were a couple things. So one was I was projecting my own experience onto a much larger group. So I've been working out in gyms since I was 13 years old. And so I had a lot of experience, in different gym settings. And I just thought, well, this is phenomenal to be able to have a professional workout in my living room. And I've got young kids and I only have a lot of time to go to the gym. I imagine a lot of people are in the same boat. You see the cancellation rates at gyms, they're awful. They're just terrible. Like people don't stay. They do the January membership and then they're done. And so I kept thinking, what if this is a better solution for people? That it's not that they don't want to work out, it's just they don't want to go to a gym. Maybe they're not self-conscious. Maybe they just, it's hard they don't have the time to, whatever it might be. I thought Peloton could really capitalize on that a lot more. And so, I'm still a Peloton subscriber. I use it quite regularly. I think my workout streak's like 150 weeks in a row or something. So nice. Something that I use all the time. But it became clear over time with Peloton that the TAM was much, much lower than what it could have been. I think in a way, COVID kind of ruined the opportunity. I think had COVID not happened, I think Peloton maybe would have been a little bit more financially disciplined.
Sure.
Over that time, because looking back, it's hard to say that management, under most circumstances, wasn't making the right decision. So they were trying to service their customers, delight them during a period where they couldn't get access to bikes, and so they were flying these bikes in, building inventory left and right, trying to make sure that the customers weren't waiting around for bikes, whatever it is. And then there were some cultural things that came out of that, so it kind of compounded on itself.
Sure.
One of the things I when we talked about moat trend earlier, thinking about negative moat trends, I firmly believe that moats erode from behind the castle walls first. So we always think about, the competition. What's the competition doing? It starts behind the castle walls. There has to be an opportunity for somebody to come in, and that's where the management team and the culture of the company has eroded, and that provides the opportunity for competition to come in. So I think that happened at Peloton as well. So definitely the worst performing investment I've ever had, and I hope to never make that mistake again. So for me, it was, trying to be conscious of projecting my own personal experience with a product or service onto a much larger group of people, and then being a little bit more conscious of base rates when forecasting too. So not projecting 30% growth rates indefinitely.
Sure.
Not that I did that with Peloton, but it was more aggressive than I typically do, because I thought this is the best thing since sliced bread, and it was just a mistake on my part, and ate the loss.
Was there something about customer community or lock-in or switching costs that you think you missed in some ways, like that you just thought this was almost like an Apple-like community where people don't there's just a passionate group of people who only use Apple, right, and will never buy a Google phone or a Microsoft phone. You know what I'm saying? And do you think you overassessed how sticky the community could be?
I think the community is still quite sticky. If you look at the numbers, their retention ratio is quite high. I think it's kind of roughly Netflix.
Wow.
Last I checked, don't hold me to that because I'm not sure. I haven't looked in the past couple of quarters, but when I was an investor, it was kind of like the switch. It was a retention ratio of a telecommunications company, which is like basically
crazy for a gym, basically. Yeah.
So I think it was more the acquisition. The incremental customer wasn't there like they expected it to be. And so thinking about the opportunity was, I think where I made the mistake was thinking that people wanted to work out at home, and that was the motivation. So I think people go to gyms for more reasons than just to work out.
Yep, I think that's
right.
true.
And so that's what I thought, also with COVID, people are going to be more concerned about exercising in a tight area to begin with, and that just wasn't the case. People, as soon as gyms opened back up, people were going.
Yeah.
And so I did not envision that in the future, and I was wrong.
Sure. Well, we all have those mistakes, and it's always helpful to do postmortems to understand where it went wrong and then learn from it.
Yep.
And so you recently started KNA Capital. You are, without any question, focusing your investors and potential investors on a long-term performance measurement, but also trying to build a business that can last for a long time. If we fast forward 7 years from now and we're looking at what KNA has become, how would you define success?
To me, I just want to help more people. So thinking 7 years out, I want to be helping more people. And however many number that is, it's hard to say, but I hope to be helping a lot more people. And that's why I started the business, just to help people. Because just from being in the industry for so long, you hear stories about people just having bad experiences with advisors, bad experience with money managers. Even friends and family of mine who have come to me as are now clients, have worked with bad advisors, for lack of a better phrase. And so the trust in our industry is hard to come by, unfortunately.
Yep.
And that was one of the reasons, I really debated, does the world need another financial advisor? Do we? And I thought, I had enough people come to me over the years asking for help that I thought maybe there's something there, right? Maybe people do need help. And that's why I set up KNA, to help people. And so success to me is being able to help a lot more people over time, and there's only so many people I can help personally, and hopefully I can scale it over time. Sure. And help more people. But that's the goal.
And how did you think about creating alignment in terms of structure and fees and all that, so that you are on this, almost on the same side of the table as the people you're trying to help?
Right. That's really a challenging thing, right? Because you're trying to start a business, trying to make it financially stable and continue to be a going concern, but also be fair with fees and alignment. And one of the things I would love to do over time is, as the business scales and I'm covering my fixed costs many times over, able to reduce those fees. So right now it's about maintaining the business and keeping it a going concern so that I can achieve those long-term goals. And my clients understand that. And Over time, I would love to be able to reduce that. So I mean, over time, the fees and can change. And so for me, is it fair? And that's what I'm always thinking over time. Is it fair to them? Is it fair to me? And if I can't fulfill my end, right? If I'm not performing, then I'll help them find another advisor, right? It's not all about me trying to earn the highest fee. I want to be able to help people again. If I'm not helping, I need to be conscious of that.
That was well said. Thank you for that. I think this has been a really good summary of where you've been, what you're trying to build, the way you think about Moats, the way that teaching and writing all, complete, really holistic process for yourself. And so we're going to close with the question that we ask all of our investment manager guests. And I'm really curious to hear your thoughts on the universe that you're focused on. What is the most underappreciated aspect of the investment opportunity in front of KNA Capital today?
So one of the things I've come to appreciate over the past 18 months or so is the importance of sustainability. Now, that's a pretty controversial word right now. And there's been a lot of blog posts written past couple of months about the downfall of ESG and sustainability. And, the way I view it is that ESG was a bubble. But to borrow a phrase from Seth Klarman, these bubbles always have a kernel of truth, right? There's always something within them that is true. And I do think that companies and investors need to be more aware of how we impact our world. And so one of the themes that I have in the portfolio that I'm looking for are companies that could help other companies achieve sustainability.
Sure.
So one of the companies I own is Ecolab. And Ecolab is helping companies reduce their water and power needs and helping companies have better, safer workspaces for their employees. And I do think that when you think about what's not going to change, that's one of those things I think is not going to change. And I'll tell you too, from working with young investors at University of Dayton, I'm telling you, they care about it. And so whether or not you think it's important, in 20 years, they're going to be in our shoes, they're going to care about it, right? And so whether it's called ESG or sustainability or transition, whatever you call it, it's going to be a real factor, and they do value it. And so I do think whether or not you agree with it or different things, it is something to be attuned to and to be open to.
And how do you incorporate that? Is you actively look for companies that are kind of on where you see as the right side of sustainability? Is it more of a nice to have if one of your companies fulfills some of that?
Yeah, so thinking about it again in terms of, again, long-term business-focused investing, thinking about what's unlikely to change over the next 10, 20 years.
Yeah.
So much change happening. What's not going to change, to use the Bezos quote, right? Think about those things. And so I think companies that are helping other companies achieve lower power usage, less carbon emissions,
sure,
taking care of water, all those things are going to be increasingly important over time. And so I try to find companies that are kind of the picks and shovels of that approach. So how are they helping companies like we own Ferguson, the portfolio. Ferguson's helping in the US replacing all of the old piping. That's a big thing too. So cleaner drinking water, all those things I think are going to be tailwinds. It doesn't mean that that's going to be the reason that the investment succeeds or doesn't succeed, but it's going to be, I think, a tailwind behind those businesses that gives me the confidence to be able to forecast these companies for longer periods of time and then hold them for longer periods of time.
Well, Todd, congrats on making a big bet on yourself. And like myself, becoming an entrepreneur in our early 40s. I think you have such great foundations that, markets cooperating will put you in a great position to be successful. So thanks for being on Compounders. Really appreciate it.
Thanks for having me, Ben. I appreciate it.
Todd mentioned a number of securities on this podcast. I do not own any of them.